Cost of capital, Chapter 11. Continuing on from Part 1, debt as a percentage of total assets. This is particularly for 2010 for these particular companies. So you can see debt as a percentage of assets was 14% for Forest Labs, 23% for Intel, 38% for Pfizer, 45% for ExxonMobil, and so on and so forth. And then for AMR, which is air travel, which is about 99%. Based off of all these averages that are provided, it's pretty consistent, specifically with percentages of debt to assets for those particular industries. Financial capital consists of bonds, preferred stock, and common equity. Within this course, we will not focus on preferred stock for the weighted average cost of capital. We'll be focusing maybe on bonds and then common equity for stocks in terms of calculating it. But money raised by sale of these securities and retained earnings is invested in the real capital of the firm, the long-term productive assets of plant and equipment. To minimize cost of equity, a firm may sell common stock when prices are relatively high. A balance between debt and equity is required to achieve minimum cost of capital. As you can see, cost of capital over time, debt-asset ratio as a percentage versus the cost of capital where it's invested. Cost of capital and the capital budgeting decision. Current cost of capital for each source of funds is important for capital budgeting decision. The required rate of return will be the weighted average cost of capital. The common stock value of the firm will be maintained or will increase as long as the firm earns its cost of capital. Investment projects available to the Baker Corporation is shown here. Project A has an expected return of 16%. The cost of $1 million is about $10 million for investment. Project B, 14%. Cost of millions for the investment is $5 million, and so on and so forth down the line. So you can see the expected return is 9.5% for the Baker Corporation, and the cost is about $20 million. Cost of capital investment projects for the Baker Corporation. So you can see the weighted average cost of capital is 10.41%, which is what they're looking for in terms of return on investments. So that would show that A, B, C, and D would be the best projects to invest in. Marginal cost of capital. The market may demand a higher cost of capital for each amount of fund required if a large amount of financing is required. Equity ownership. Capital is represented by retained earnings. Retained earnings cannot grow indefinitely as the firm's capital needs to expand. Retained earnings is limited to the amount of past and present earnings that can be redeployed into investments. Assumption: 60% is the amount of equity capital a firm must maintain to keep a balance between fixed income securities and ownership interest. The firm has $23.4 million of retained earning available for investment. There is adequate retained earning to support the capital structure as shown below, assuming X is equal to retained earnings over percentage of retained earning in the capital structure. So you can see where X represents the size of the capital structure the retained earnings will support. So we're looking at 23.4 million over 0.6 equals 39 million. Cost of capital for different amounts of financing. First 39 million and then the next 11 million. As you can see the calculation shown there. Both K and KA represent the cost of capital. The MC subscript after K indicates the increase in marginal cost of capital. The increase is because common equity is now the form of new common stock rather than retained earnings. The after-tax cost of the new common stock is more expensive than retained earnings because of flotation costs. Here's another example. You can show amount of lower cost debt, percentage of debt in the capital structure, and how to calculate that cost. End of part 2.